everyone, welcome back to the show. I'm Roxann Klepper, and this is Brick by Brick. Well, the mortgage industry has been on a roller coaster ride for a few years now. So many big changes and rate fluctuations. I have an incredible mortgage broker here with me today that I have the pleasure of working with. Arlene started in the industry in 1978 and has been a broker since 2003 with Turning Point Financial. She is truly an expert in her field. Her knowledge is second to none, and she's a go-getter. She is going to walk us through the current mortgage rates and some info about different programs and what's changed recently. Arlene, thanks so much for being here with us. Why don't we just start at the beginning? I was thinking you could give us sort of an overview of year-over-year data, maybe some economy information, and maybe some differences that have changed since COVID.
Yeah, okay, sure. Well, I think first of all, let's just start out with where the rates have been, like, starting out, in 2020 when COVID hit. The 5-year fixed rates in 2020 were running around 2.4%, and then in 2021 dropped actually down to 209. That was kind of when the Bank of Canada said they were going to, have emergency rates held. But then going into 2023, it jumped up to 3.83, and then or 2022, sorry. And then in 2023, all the way to 5.12. So, quite an escalation in a pretty short period of time. And the prime was not a lot different. 2020, we were really 2.54. 2021, it went down to 1.58. And then in 2022, it jumped to 3.57. And then we capped off in 2023 at a high of 7.2%.
It's a huge jump, hey, from
It's a massive
1.58
jump.
to, yeah.
Yeah. And so that's been, a lot of the problems have been with people qualifying, people that are in, say, for example, variable rate mortgages. We were told by Tiff Mecklin, during COVID that they were going to hold those rates down, and then did precisely the opposite. So there were quite a few people that kind of got, stuck in that, because qualification, if you look at, say, when the prime was at 1.58, a stress test of 2%, they were only stress testing at a much lower rate. So a lot of people were kind of forced into the variable rate, to qualify. There was quite a few of those people. And so then they got stuck. And so, it's good to say that we're now at the 5.45 mark, and, moving into this next year. I mean, the Bank of Canada has already indicated that they'll be dropping it probably every review period between January 29th is the first one this year, and then every 6 weeks moving forward after that until late spring, early summer. So, sort of talk on the street, getting back into that 3 to 3.5% range, which is much more reasonable for, folks to be able to qualify.
For sure. And so then what would that put the stress test rate at?
Well, it's always 2% above. So right now you can get a variable at prime minus 0.85. The banks have kind of decreased the discounts. We were getting prime minus 1, prime minus 0.9. It's now prime minus 0.85. So, you can tell that the banks are hedging their bets a little bit and padding that somewhat, because they know the rates are going to be dropping, significantly.
Okay.
So, if you were at 4.6, you'd be qualifying at 6.6 right now.
Okay.
And
And
5-year
so
fixed
basically,
now are running like 4.19 to 4.59. So again, 6.59-ish
right.
for qualification.
So basically those banks are hoping that a bunch of people will get locked in now at a little bit higher rate before it all drops.
Yeah, and
Yeah.
it's been kind of difficult helping people transition, because so many people have been burned by what happened, right, during this past few
Right.
years, that there's a real tendency to, jump for that safety of taking a fixed rate. And so, you know, um, and it's always difficult for us, because, whatever you say, you kind of get held to the fire somewhat,
Of
even though
course.
you're not really in control. But we are going into an election year, thank goodness, and I think we are going to see those drops. So I'm really recommending to people, take the variable rate seriously for now, ride
Okay.
that rate down,
Yep.
until, say, So, and then lock in. If you're
Okay.
concerned about, being stuck again, don't sort of, tie yourself to a rate that you're going to be kicking your butt over, by
Right.
summer because you're paying too much.
Yeah.
And then just ride that rate down. You can lock in a variable anytime you wish. So, it's a perfect opportunity for people to somewhat have the best of both worlds while we're in
Okay.
that declining phase. Yeah.
Right. And so that will sort of get them into a low rate now, get them into an even lower rate till they come to sort
Yes,
of their bottom for now, and then
that's
lock
right.
in when it's sort of at its bottom.
That's right. Yeah.
Yeah. Okay.
Yeah.
Yeah.
Yeah, for sure.
And
And
so,
no, go
sorry,
ahead.
Arlene, when what does the Bank of Canada think the bottom is? Like what's their target? What are they trying to get to?
Well, they're targeting around that 3 to 3.5%,
Okay. Yeah.
and we'll see. The fixed rates, on the other hand, have been a little bit more difficult to predict because, it's tied to the bond market.
Mm.
And, with the monetary policy that we have in place right now, we've printed a lot of money. And so as a result of that, investors want a little bit better return on their money. And the bank is always looking for a spread of 1 to 1.5% between what they're paying you on the bond and what they're charging someone else on a mortgage. So,
Right.
um, but still shooting for that 3 to 3.5%. We'll see how that lands. I think right now we're probably more certain of where the prime is going than we are the fixed
Right.
rates, because actually
Okay.
we got a slight bump. We were down, a couple months back. We were getting 5-year fixed money at as low as 3.99, and we're back up to 4.2 to 4.6. So, it has had a little bit more volatility to it for sure.
Okay. And so maybe just explain to people the direct relation with the bonds and the rates. So what happens when rates go up to the bonds and what happens when it goes down?
Well, I mean, when the bond rates go up, your mortgage rates go up. When bond
Okay.
rates go down, your mortgage rates go down, right?
Right.
So,
Okay.
and that's what we're looking for is, that monetary policy to set those bond rates a bit lower.
Gotcha. And so is that sort of what you're thinking for the next 12 months is that there'll be some reductions by summer
Yes.
every 6 weeks,
Oh, yeah.
and
Yeah,
then
for sure.
for it to kind of go flat after that or steady anyways?
Well, we're hoping for steadier, but there's just
Yeah.
so many wild cards right now.
Right.
Like one thing that's really, concerning, in Alberta, we're in a good place compared to the rest of the Canada because our economy is growing and unemployment and whatnot is much better, even though people are still feeling pressure. But in Ontario and BC is another matter. Like unemployment is up to 7%. Bankruptcies are the highest they've been since '08.
Oh,
Um,
wow.
the economy is actually contracting, and in the mortgage market in Toronto specifically, I mean, you have people that contracted for a new condo, for example, at $1,280 a square foot, and market value is only $980 right now.
Isn't that
So,
wild?
there is what happened during COVID did create a bubble, and all of the immigration put additional pressure on that as well.
Hmm.
And then when you add to the construction industry, there's it's so difficult for permitting, and the costs in Toronto, for example, 30% of your cost is based on permitting and
Yeah.
fees and construction, studies, all of that kind of stuff, all the environmental. It's added a lot onto the price of a property. So that affordability is huge. And the two things that kind of tie, the mortgage market is construction activity and employment and interest
Right.
rates, right? So
Yeah.
both the interest rates and the construction activity have dropped. So, there is cause for concern. And so as a result, what you're really seeing is that lenders are much more risk adverse than they were
Okay.
before. And so, getting money, getting funding isn't as easy as it was. And it
Okay.
probably won't be until such time as, and then when you look at the looming tariffs in the US and the impact as well, all of that kind of feeds into the overall climate.
Right.
Yeah.
And so interprovincial migration, I think we're still going to see that being high, but that's
Yes.
definitely why we're seeing it, right? We're seeing those
Yes.
those costs of that little bubble in Toronto and Vancouver where
Yeah.
1280 a square foot, that is just nuts.
Those are for condos. Those are for
Yeah,
dog crate condos in Toronto. And it's just, it's mind blowing, right? When you
yeah,
think about it. So,
yeah.
yeah, I think there's lots in Alberta, I think, to be positive of, but we're still, tied to tethered to what's going on in the rest of the country because that's where the monetary policy and the rates are going to emanate from. That's where the bulk of the mortgage market is at. So,
Right. Which is probably a good thing for us. So if they
oh
see,
yeah,
sort of this buyer's market going on in Toronto, that will get lowered and it will help us here because obviously
for
our
sure.
economy is a lot stronger. We're not seeing the issues they are yet.
That's right. Yeah,
Yeah.
I don't think we're gonna, I don't think anyone in Alberta has to worry about their values whatsoever. If anything, they're gonna continue to increase, right? I don't
Yes,
think
agreed.
we're in a position where, different story in Toronto and in Vancouver for sure.
For sure. For sure.
Yeah.
And so, besides all the rate change fluctuations that they've been doing, they've also made lots of other changes, policy changes that we've never seen the likes of before, like the
Right.
30-year mortgage.
Yeah. So
So can you tell
the
us a little
30-year
bit more about
mortgage.
that?
Yeah, I'm not a big fan of it, to be honest
Okay.
with you, because the cost to the consumer, if they take that 30 years, are, definitely much higher. However, if it's the difference between qualifying and not qualifying, then by all means, usually what I do is if it comes down to that, I'll say to the client, let's take the 30 and I'll show you how you can prepay it to get rid of it sooner. Because, if you exercise your prepayment options, then most definitely you can control that amortization.
Okay. And
Yeah.
so is the 30-year mortgage for everyone? Can
It
anyone
is
apply
now
for it?
as of
It is
yeah,
now.
as of December 15th, I believe, of 2024 is when that came into effect.
Okay. And have you been seeing lots of them? Lots of
No,
people that want to? No. Okay. Yeah.
no. I've had a couple of people inquire, but when I actually showed them the math, right, between the
Right.
difference, it was kind of like, now we'll just go with the 25-year kind of thing. So,
Okay.
yeah, I would, any of those programs, I would definitely put a client into that if it was the only thing stopping them from buying, for sure.
Right. Yeah.
Yeah.
And so, speaking of programs, are there some other programs out there right now that are helpful to people trying to get into the market? Are there special things that they should know about?
Well, there is a renovation program that's pretty cool, that's
Okay.
coming forward, and that is up to 1.5 million, of course, because the CMHC limit did increase.
Yes.
Um, Again, I don't think that's going to have a huge impact in Alberta because the
Yeah.
amount of money you have to earn at these rates to qualify for that size of a mortgage is usually a non-starter for a lot of people anyway. But the option to be able to convert to, say fourplexes and multi-use types of
Oh,
situations, right? That program, we're short on details yet because, of course, they announced it without really running anything through CMHC, or a lot of the administrators are going to be running the program.
right.
But I do have one client that's actually interested in it. He's looking at buying, a property and, rental property. He's going to have it live in one suite and then have four others. So, you can increase the likelihood of, I think the idea by the government was to increase the number of housing, spots that we have available because we're so short. So
Right.
this was one way to do it. But now you're running up against the permitting and all of the other, planning, issues that may come along with doing that.
Sure.
But I do think that could be a good program for people, especially if you're talking about multi-generational, where you might have parents that want to move in with the kids but still have their own suite, and
Right.
there's that program. I'm going to try and get a little bit more information on. It's been sketchy in terms
Okay.
of the actual details as to how it's going to roll, but
Right.
that could be a good one for sure.
Yeah.
That
It
one I
sounds
think
like
could be
it.
good. Yeah.
Especially as the municipalities and even the federal government kind of encourage
Yes.
everyone to go multifamily instead of
Yeah,
single
that's
family.
right.
Yeah.
That's right.
Okay.
So I
That's
think it's
interesting.
just going to be a little bit of a lag time over the next few months between that
Sure.
announcement and when they kind of get those policies and procedures kind of matched up with the program. So, yeah.
Right. Nothing like announcing it before,
Yeah.
I actually have it in place, eh?
Yeah, for sure. Well,
Yeah.
I mean, it's not the first time that's happened with these kinds of things, but I think, really it became very reactionary, right? Because there is such
Okay.
a huge shortfall of properties, especially again,
Right.
well, even here, I mean, our vacancies are still extremely low, right?
So low. Yeah. Interesting. And so there was one other question I meant to ask you earlier when we were talking about the stress test and the refinancing.
Yeah.
Um, Now, is it true about the refinancing that someone that's doing that does not have to qualify for the stress test again?
No, it's not. If you're switching your mortgage for no new funds, then you don't have to qualify. So
Okay.
if you're just wanting to just sort of take your mortgage from, lender A to lender B, for a better rate, for example, then
Yeah.
most definitely you don't have to qualify on
Okay.
that. But if you're refinancing, the minute you're taking new money, you have to requalify.
Oh, okay. Okay.
Yeah.
That makes sense now. I thought I read that it was for any refinance, so I'm glad you clarified. That makes sense.
Yeah, it's no, not so far.
Yeah. Okay.
You still have to qualify on those ones. But um the thing is that you might find it easier to requalify. Like we are looking at a lot of refinances right now, for sure.
Yeah.
Like there's a lot of mortgages coming due 25, 26, 27 across the
Yeah.
board, right? So, for example, like TD has a good program. You just take out 20,000 and maybe combine other debt. Like they just want some new money, and then you can reamortize, right? So those might be they're still qualifying, but at the end of the day, let's say you were down to a 10 or 15-year mortgage, right? Then you
Yeah.
could maybe combine other debt that you may have
Okay.
incurred through COVID, right? If you have enough
Okay.
equity in your home, and refinance that, take that amortization back up to 25, 30 years, and you can provide quite a bit of payment relief for people, and also maybe
Okay.
get them from higher interest rate. Like a lot of times we talk about using the avalanche method for getting rid of debt, right? Which is where you just pay your minimum payments and then do heavy lump sums on the highest interest rates and sort of work your way down from highest to lowest rate. But
Right.
obviously, if you could consolidate, and refinance into a new mortgage at a much lower rate, you can really help people gain some traction back that they may have lost during COVID.
Right. And
Yeah.
actually, great timing because that was my next question. Are you seeing people refinancing for the purposes of lowering a payment because the rate has changed, so much from the last time they renewed? Like, has there been enough change that it makes sense for someone to refinance?
It can, especially if they're carrying a lot of other debt. Like,
Okay.
through COVID, a lot of people ran their lines of credits up because they had to, right?
Yeah.
Some people took CERB money that they've had to
Mm-hmm.
repay.
Mm-hmm.
There's been sort of a plethora of, sort of a perfect storm, if you will, that's
Mm-hmm.
happened to people, right?
Yeah.
So it is actually a very viable way for them. But the key there is that they have to have the equity. So anybody that's purchased in the last 5 years is probably between a little bit of a rock and a hard spot.
Okay.
Some people's
So,
amortizations have actually increased. For example, if you were with a variable rate with a bank that didn't change your payments so that you kept pace, right? You
yeah,
can
right.
actually be in a negative amortization, right?
Oh boy.
And so how do you catch up with that? So there's those kinds of files on refinances and renewals that I'm looking at trying to help people with as well.
Okay.
Because
A
right
little
now they're on a
more
never never plan, right?
for sure. And so a little more to navigate than just,
Yeah.
30-year mortgages or the lower rates, so much
Yeah.
other things going on behind it.
Yeah, for sure. For sure.
And so are you still seeing lots of people maybe not qualify? Like I know you said the banks are a little more less risk averse to it. Do you
Yeah.
see lots of files getting turned down, or are there still lots of people getting approved for mortgages?
Still getting lots of people
Mm.
approved in Alberta, particularly because our prices are still somewhat reasonable, right?
Right.
But if I talk to a lot of my, cohorts in BC, for example, it's a different story. The market has really tanked. There's very little activity.
Right.
Values are dropping. And then, so when it comes to a refinance, for example, if the bank is worried about, the erosion of value, they're going to
Okay.
be very reluctant to take you to say 80% of what your value may have been when you purchased in 2021, for example, right? So,
Right.
so I think here in Alberta, we're not in that spot. People's values have stayed much more stable.
Right.
So as long as they've got equity, like as long as we can keep it to that 80% mark, I think we're pretty safe, right? But it is definitely something that is having to be navigated in other provinces for sure.
Oh,
Yeah,
very interesting. I'll
yeah,
be curious to see kind of how that interprovincial migration continues into 2025 with what's
yeah.
going on, in those places. You see the values go up in those places, migration to Alberta increases. With it going down, I'm interested to see what that looks like going forward.
Yeah, I do think that we're going to continue. And also, you look at the project that was just announced, the AI project up in Grand Prairie, right? And all the
Yeah,
people that will be coming with that. And I think really honestly with a new government that might be a little bit more friendly, especially on the Alberta and the energy sector, then of course we're going to see huge gains there as well.
right. Someone made a comment the other day about if you're looking to buy a rental property, buy it in Grand Prairie right now.
Yeah, absolutely.
Right? Yeah,
Absolutely. But, I think Red Deer is the best value in Alberta right now for the
yeah,
size of the city, no question, right? So
yeah,
if,
no question.
and if anybody is energy related or isn't necessarily tied to a location for work, that
Right.
remote workers, for example,
Yeah.
Red Deer is probably the best place in the province to be right now, price wise or value wise.
Value-wise, yeah, still one of the most affordable places in Canada, really.
Yeah.
And I mean, the Calgary market went up 20%. The Edmonton market is actually set to outpace Calgary this year, which I
Yeah.
find very interesting. So, yeah, we're
Yeah.
we're holding our own here.
Yeah, for sure. Yeah, I think I'm really grateful to be in Alberta right now because I think that it's going to be a little bit of slogging for the people that are in the east and the lower mainland for particularly.
For sure. I follow another realtor out of Toronto, and he's always talking about the downtown condo market. They
Yeah.
are in such a severe buyer's market right now.
Yeah.
He said you can't even give one of those away right now. It's just
Well,
empty condos everywhere.
well, and the other thing I think that is of note is that, we have 5 million people here that are all expiring within the next year. And, a lot of people that have bought rental properties thinking that that rental market is going to stay stable, but that's probably going to start dropping too in
Right.
those markets, right?
In those markets for sure. Yeah. Well, that was great info, Arlene. Thanks so much for the update. Now, I always include everyone's contact info at the end of the podcast. So if you want to reach out to Arlene, if you have questions about your existing mortgage or you're ready to sign up for a new mortgage, all of her contact info will be there. You can reach out to her and get started with the process. So thanks
Great.
everyone for joining us. And Arlene, thanks so much for sharing all of your wisdom with us.
Thank you so much for having me. It's been great.
Yeah. Have a good day.
You too. Okay. Take care.